Hey everyone, it's Matt. In this video, we'll be diving into how to break even on your trades and whether or not this is something you should do, as well as some common mistakes that a lot of people make when it comes to setting their trades to a break-even position as soon as possible. As always, if you enjoy this video, be sure to drop a like and subscribe to this channel if you haven't yet subscribed. So first, let me quickly explain what a break-even position is. Let's say that we have a trader that decided to enter a buy position, so right over here, and initially they had a stop loss that was set maybe below the market structure, so down over here, and initially the market was going in their direction. So in this case, they would have an active trade that's currently running and they would be sitting in profits. So what some traders might do is they will take their stop loss and they'll move their stop loss up. So they'll move it up to where they initially enter their trade, or perhaps slightly above it to cover for some fees. And so now if the market goes against them, so again, the market hasn't reached their take profit level. So if the market were to go against them and drop down to where they initially entered the trade, their stop loss would take them out. So essentially you would be exiting your position at the same level at which you entered your position. So you wouldn't be exiting the trade with a loss, but you also wouldn't be exiting your trade with a win. So it's essentially a neutral position of where you get out of the trade and you don't lose any money, but you don't win any money. Now, a common saying that you might hear when it comes to break-even trades is that break-even trades are essentially risk-free. And that's because once your trade is in profits, well, now you bumped up your stop loss to where you entered your trade. So if your trade goes against you, you're technically not exiting with a loss. So it's risk-free, right? And the reason why that's wrong is because every single trade that you take in a market, so before I take any trade, there's a probable chance that my trade will go against me and I'll experience a loss. So if I have a stop loss, it might go against me, hit my stop loss, I'll experience a quick loss. Or for those traders that don't have a stop loss, well, the market might go severely against you, and that's where eventually you'll experience a much bigger loss. But essentially what I mean is that every single trade that you take is a risk. Putting any type of money into the market that has the potential of being lost is a risk in itself. And so now that I got this out of the way, let's move on into how to actually apply break-even positions to your trades if this is something that you wish to do. So I'll be going over a common mistake that a lot of traders make, and that's, to begin with, setting their trades to break even as soon as possible. And so in this example, we're looking at pound Aussie, and this is actually a swing trade that I mentioned in my trading community last week. So I wanted to short this pair, and the simple reason why is because I saw a change in the weekly market structure. So initially it was bullish, then we rejected this weekly psychological level of around 1.91. We experienced this correction over here, and that's where price retested this daily zone of where we saw signs of a rejection. And I also saw these wicks and a spike above these recent wicks, essentially counting as a stop hunt, which would liquidate some traders before we saw this bearish daily close. And also some traders might look at this as a supply zone. So there's a lot of factors when it comes to looking at this trade as a potential short. So this is where I sold, and my take profit was down here, my stop loss was up here. And so now when I play this forward, we can see that essentially 2 days later, so let me zoom in for you guys. So 2 days later, we can see how price action at one point in time dropped all the way down here. And so at one point this trade was in profits. And so what some people might do is that if they took this exact trade, what they would look to do is to set their stop loss, push it up to break even, and call this a win, and to not worry about price action retesting their entry level because they're sitting in profits. But the reason why this is a mistake, and if we play this back, then we can actually see this trade ended up moving in my favor. But the reason why this is a mistake is that if I drop down to the 4-hour market structure, so I entered right around here. So despite the fact that I was sitting in profits, we can look at the 4-hour market structure. So the past regions of where we saw support and resistance, and we can see that despite price action closing or attempting to close below this zone, so we had a wick, so in this case we wicked multiple times below, price action closed pretty much within this level and it closed back up. And the reason why is because price action was essentially ranging. So we were moving sideways, meaning that there's no trend on the 4-hour market structure. So until there's a shift in this market structure, the higher market structure is also not going to change. And so we tested many times below, but it didn't significantly change until we finally got this bearish close on the 4-hour chart. And that's where price action retested this level, rejected this level, and then it dropped. So a better solution, instead of simply setting your stop loss up to break even, is to look at the market structure. So look at the price action, drop down to the lower time frames and see what the price action is doing. So what I saw was that price action was still ranging, which meant that I knew that this level could get rejected and we could still push back up to the upside. And so I wasn't basing my stop loss off of the fact that I entered right around here. I based my stop loss off of the fact that we had this range, so I moved it outside of the range. And at this point, the best time to have set your trade to break even would have been once price action breaks out of this range. So once you actually see the market structure changing, and so if you have a range, you would want price action to break out of the range. So once you see that that's something that happened, that's when you can adjust your stop loss and move it up, perhaps to break even, if that's something that you wish to do. Now, the second thing that I wanted to discuss is, and this is a little bit counterintuitive to what the title of this video may suggest. So initially I was talking about only setting your trades perhaps to break even. But what I think is a bit better, which sort of ties into the previous example of what we were looking at, is that you should probably, instead of simply moving your stop loss up to break even and moving it right where you entered, what you can do is, and this is totally optional, is that as a trade goes in your favor, so as a trend, in this case, let's say this is where I decided to buy and the market structure was moving up to the upside after ranging for a little bit. So as this trend plays out, what I can do is I can base my stop loss off of the lower market structure. So instead of simply setting it to where I enter this trade and just keeping it there, if price action continues pushing upwards through this trend, I can move my stop loss up and base it off of the market structure, because I know that, let's say if my trade does not reach my take profit point and it gets very close and then it starts to reverse, instead of simply waiting for all these profits to go away, so in this case, let's say I was risking, I don't know, $500 and my take profit was $1,500. So I'm just making these numbers up, but instead of simply waiting and just not doing anything and just waiting for price action to fall all the way down to your break-even level, it's better to move the stop loss up. And again, this doesn't mean you need to push it right behind price action, because at this point you can encounter a pretty big risk of getting taken out by a manipulative move. But what you can do is that if price action, let's say, is trading up here and it's pretty close to your take profit, this is maybe where you might set your stop loss up below a recent level of, let's say, support. And if there's a lot of equal lows and you're afraid that the market might manipulate you, well, then you can leave a little bit of extra room. But in this case, I would move my stop loss up a third of the way, or maybe halfway to my take profit level. Because at this point, I know that if the market structure were to change and we see signs of a reversal and we start pushing down again, instead of just waiting again for price action to push all the way down and to hit my break-even level, it would take me out at a level of where I can still cash out on some profits before it continues pushing down again to where it's most likely going to take me out regardless. And the last point that I just wanted to bring up is that you probably don't want to make it a habit when it comes to setting your trades to break even or constantly moving up or down your stop loss. As I mentioned previously, this is totally optional, but the reason why you don't want to make this a bad habit is that, first of all, we need to accept the fact that you might encounter a probable win or you might encounter a probable loss. So I've mentioned this in previous videos where you might have a winning streak and you don't know what's going to happen next. So you might have 5 wins in a row and then you might encounter 5 losses in a row. But this is simply the reality when it comes to trading and investing, and that's that you will encounter probable losses. So having the habit of constantly looking to break even, part of it might have to do with the fact that you have a little bit of fear, so you might be fearful when it comes to accepting a probable loss. So in another example, you might have a trader that enters a trade, their trade is going against them, and then this is where they move their stop loss down, and then as soon as their trade goes up again and is in profits, they're just glad to not be in drawdown, and so this is where they will look to take their stop loss and they'll push it up again, and at this point they won't care whether or not they break even. They're just happy that they didn't experience a loss. This isn't teaching you whether or not you entered correctly or whether or not you based your stop loss correctly if you're moving it back. So sometimes it's simply better to accept a probable loss, and getting out of a trade at break even is not teaching you the fact that you're basing your trades off of the market structure, or that maybe your entries are wrong, or that maybe your stop loss was incorrect. This is simply a habit of not wanting to accept a loss. So let me know down in the comments if you guys found this video helpful, and let me know which topics you'd like for me to cover next. And of course, drop a like on this video and check out my trading community. The link is provided down in the description of this video to the Telegram app and the Discord app. Thanks for watching. I'll see you guys in the next one.